Let's begin on this Fed decision because traders now pricing in a 66% chance of a cut in November. I think you have to ask the question, can the Fed actually cut rates this year?
There was no surprises on the Fed did last evening, Dan. It was a tad bit less hawkish than what we had anticipated. They kind of emphasized back and forth that the policy rates are sufficiently restrictive, basically knocking out any further tightening going forward. What was also interesting to see from the messaging was that the next move of the Fed could actually be a cut rather than a hike. Market is pricing in 1 full basis point of 1 full rate cut by the end of the year. I think 2 is still doable, Dan. We just need to see, we just need 2 very good prints on CPI and PCE back to back, and that could actually change the yield curve at the moment. And I think what is more important is for the Fed is how the market is actually pricing this going forward. And last year, if you look at it, inflation was very hot in the first half of last year, in the first quarter of last year. And over the year, as the year progressed, we saw it was tapering down. We saw that there was a residual seasonality which was getting kicked off, which can actually happen this year as well. And let's not forget that anecdotal evidences do suggest that there's economic weakness coming into the picture. Consumer spending is also a bit weaker than before. Consumers are, tightening their strings. We are seeing that from a number of results that's coming up on the U.S. equity market. So I think the wage growth can moderate, and I think 2 rate cuts is quite doable by the Fed before the end of the year.
Okay, so 2 cuts still on the table, but you mentioned it just before, and it's the headache around inflation right now. Powell saying he needs to see more evidence that inflation is sustainably returning to that 2% handle. So what are the factors that are keeping inflation high at this point? And I guess to a broader point here, how much evidence will Powell need to see in order to confirm that rates can come down here?
I think everything boils down to labor market. I think labor market is something which is actually holding up pretty much everything. It's holding up the inflation, it's holding up the consumer spending, it's holding up the retail sales, it's holding up the economy, it's holding up the GDP of the US economy. So for me, the key thing to watch, and rightly he said the same thing. I mean, labor market is something which he's very closely watching other than the inflation. If he sees labor market to weaken, and I think we are seeing a migration on the labor market front. I mean, we are seeing from a tightening labor market to a more balanced labor market as we speak at the moment. And if we start seeing cracks in the labor market, I mean, when you start to see a crack in the labor market, it doesn't stop until unemployment reaches 1 or 2% higher, and that shift can happen very quickly. So I think he's also watching the labor market. Any weakness out there could actually give him more opportunity to cut sooner than later, in our view.
Okay, fascinating. Also have to ask you about the big swings that we've seen in the yen. The question is, have we seen intervention at 160? And does any of this, the Fed in combination with the currency movements that we've seen, ultimately impact portfolio allocation for you?
We did see an intervention way back in 2022 at around $68 billion. At that point, it actually was successful because the Treasury yields were coming down. We do get to see some interventions. Apparently, a couple of weeks back, we had yet to get confirmed numbers, but they're talking about a $48 billion of intervention in the market. But it hasn't really done anything. Yes, true that yen strengthened on that particular day, but the change of direction of the travel of the yen hasn't been very significant. That makes me think that probably BOJ is throwing good money after the bad. And there's nothing much they can do but to just wait and watch, because all of these movement in the yen is because of the upward momentum you're seeing in the U.S. Treasury yields. And there's nothing much they can do but just wait and pray that U.S. monetary policy takes a U-turn. Any further intervention that they do would be extremely futile in our view.